The broadcast is now starting. All attendees are in listen-only mode.
Good day, ladies and gentlemen, and thank you for joining us today for our webinar hosted by Standard Bank Financial Consultancy. My name is Teresa. And today our discussion is how you can plan for your retirement by using your tax deductions. I want to check that everyone can hear me and there is no issue with the sound. So if you can hear me clearly, please can you click on the small hand that looks like a high five. It's on the right hand side of the screen. Please know that you can raise your questions during the session, which we will answer at the end of our session. I will now hand over to Errol, who is the head of advisory. Thank you.
Thank you, Teresa. Well, good day to all attendees. Welcome to our first webinar in 2018, and we hope that confidence is restored in our economy this year. Now, the budget speech will be held on the 21st of February 2018, and it's a well-known fact that we are plus 50 billion short. There is not enough taxpayers to carry this burden, and the increase in the VAT rate may have very disruptive consequences. Wealth taxes will also not really solve the problem. Now, if the marginal tax rate increases again, then we should really seriously start revisiting our financial goals. We may have to reprioritize some of our goals. However, we have very little room to play when it comes to retirement. How often do we hear that 3 to 6% of persons cannot afford to retire? We will have to start looking at other options. One is, for example, to postpone a retirement to a later date or have a plan B in place. Another way of thinking is to ask whether the concept of compulsory retirement should not be challenged. Why must I retire? Why can it not be a choice? Latest trends in the retirement legislation shows that we are moving in that direction. That is, the date that you have to retire from a retirement annuity is no longer 70. It can be indefinite. Persons can move their funds to preservation funds or extend their exit from their pension fund after the date of retirement. After all, retirement is just but a day in our life. The beauty about investing into a retirement fund is that the higher the tax rate increases, the bigger the tax deduction. A retirement annuity is thus a tax increase neutralizer. Coupled with that, it remains a perfect vehicle to plan for a retirement goal, albeit only a day in your life. But you get to choose that day. Also, a retirement annuity in its current format may solve many other estate planning problems as well, and there's no longer a pure retirement vehicle. The only drawback is that, as a quid pro quo for the tax relief afforded by SARS, is that 2/3 of the fund must purchase an annuity. But that may suit the risk profile of many retirees. So depending on personal circumstances, a retirement annuity becomes a very valuable, tax-effective investment vehicle. So let us first see what it is that we are going to discuss today. Well, let's have a look at the agenda. Now, my intention is to focus on the current tax deduction after the many changes to legislation since 2015. Now, a major change and challenge because of latest legislation is that a taxpayer must be able to calculate his complete tax calculation before he can calculate his maximum retirement contribution. This was not the case in the past, with the result that taxpayers who receive trading and business income as opposed to fixed salaries may often need the assistance of his tax practitioner who completes his tax return. Another major positive change is that the capital gain upon the disposal of a capital asset may also be taken into consideration when calculating a retirement annuity contribution that may qualify for tax relief. Therefore, if the capital gains tax rate or inclusion rate increases for the 2018-2019 year in the budget speech, 2018, the retirement annuity may also provide some relief to offset the negative tax effect. Also here, certain knowledge of a taxpayer's affairs may only be known to the tax practitioner. For example, the calculation of the base cost of a capital asset, method of valuation, etc. Now, against that background, we are going to say we are going to look at why do we invest in a retirement annuity fund. I'm going to present to you a very short facts of a case study, and then I'm going to introduce you to a basic tax calculation, because we must be able to understand a tax calculation before we can get to calculate the retirement annuity. Some terminology is important, and there are three main concepts. If we understand that, it actually becomes very simple. We've got to look at current legislation, because the latest change only happened as recently as the 18th of December 2017. So it's only recent, and it's been changing year on year since 2015. And then we're going to do the actual calculations based on the case study. We will be looking at other scenarios. Why is a retirement annuity from estate planning point of view? And then I want to answer the question, so what if I overshoot and I make excess contributions? Is it all lost? And this is where planning comes in, where a financial planner can be of a great assistance. So I'm going to look at the position at retirement, and I'm also going to look at the position at death. And then the options that we have at retirement, and also look at those various tax calculations. So I'm going to be tax driven so that we can understand how much we can claim at the date of retirement, what can happen to excess contributions, and even after the date of retirement. So all three stages of the retirement process will be covered from a tax perspective. Let's start off then with the nature of a retirement annuity in the planning landscape. Now I make this suggestion. Retirement annuities became an estate planning, think of trust, financial planning, think of post-medical expenditure and financial lifestyle goals, as well as a tax planning tool, income tax, capital gains tax, and estate duty, none of which is payable in the fund. Although it is, and historically was primarily intended for retirement purposes, and therefore I refer to a retirement annuity as one of those eighth wonders of the financial world. It just solves so many problems in a financial planning environment. But let's set the scene. Why is it that we do this? Well, you may be familiar with our wealth quadrant, and there you see on the left-hand side, representing of your assets, that is creating value, my work, my salary, and my investments. And what do I use that for? To give purpose, to live and enjoy after retirement, and perhaps some people want to leave some inheritance for their children. The beauty with the retirement annuity is that it ticks all four boxes, and this is where planning opportunities are available. So let's drill down into the tax. Now, I'm doing a comparison between the tax payable in 2016-17 year of assessment and the current year of assessment 2017-2018. So on the left-hand side, you can see in the first band that the marginal tax rate was 41%, and the primary rebate a little bit lower, 13,500. Then came the shock. And in the last budget speech, and which is applicable for the end of this year of assessment, end of February 2018, is the current rates of tax. And a new band was introduced that people earning over 1.5 million will actually pay 45% tax, marginal tax rate. And there's a possibility it may increase with the budgets. We'll see what happens. But bear in mind the importance of this is, if you invest into a retirement annuity and you pay tax at the rate of 41%, your deduction is 41%. If you pay tax at 45%, then your deduction is 45%. And that's why I refer to it as a neutralizer. And you get to stay on the same goal that you plan. This is why I regard this as such an important vehicle. So, there in blue, you'll see the current one, and those are the rates we're going to deal with. And I'm going to do some calculations with a 45% rate. So let's start with a very simple example and say how much tax can be saved. So I took an example a person who earns a gross income of 600,000. Now, I told you that you must be able to do a basic income tax calculation. So let's just understand the fundamentals. Let's make it simple. A person has a salary of 600,000 rand. He has no retirement fund. His taxable income would be 600,000. Then he'll go to the tables, you do the tax calculation, and you will find out how much tax that is due. Now, that compared to 2018, that was 2017. In 2018, when you look at the calculation in the middle row, the gross income is 600,000, and when we eventually do the final calculation, it's about 153,000. Very little difference from 2017. But remember, I don't take inflation into account and I don't take salary increases into account. Now, without doing the calculation, and I've done it, that person is able to contribute 165,000 to a retirement fund. The effect of that is, if you look at the right-hand side bottom, that the tax due has dropped to 92,000. So it's dropped from 153,000 to about 92,000. So that is the impact of what a retirement annuity can do on your personal tax affairs. And let me add, there are very few tax breaks out there. For some reason, government has thought it a good thing to give us a higher tax deduction for retirement annuities. And it is a good thing because you want to encourage people to save. So that is a tax break that I cannot think a taxpayer is not taking advantage of. So I'm going to do a similar example. Let's just compare example where the gross income is 1.5 million. I do exactly the same thing. The tax due is 520,000. 2018 here, you'll find that the tax is actually a little bit less on that amount of exactly 1.5 million. But this person would be able to contribute to a retirement annuity. As a matter of fact, if you do the calculation, it's about 400,000 something. But you are limited to 350,000. So let's assume he made use of the full amount, and that represents pension fund, provident fund, the retirement annuity fund, whichever retirement fund, you just aggregate it. But look at the massive tax saving, where the tax due in a 2018 year of assessment is almost 520,000. It drops to 376,000. It's a tax saving, immediate cash flow tax saving of a massive 143,000. The effective tax rate drops from 35% to 25%, and this is now coming from 45% percentage rate, marginal tax rate. Good. So now that we understand this, and there are advantages, let's see how do we calculate, because it can differ from person to person. So in the following slide, I'm going to stick to this very simple case study. Let us say, and if you can remember these numbers, it will help you a lot. And I'm going to use the same example over and over and over. During the 2017-18 year of assessment, Mr. X sold his collective investment for 540,000, which is subject to capital gains tax. And he obtained it for 10 years ago, let's say for 100,000. Now he wishes to calculate the maximum contribution that he can contribute to a retirement fund, pension, provident, or retirement annuity for this year of assessment ending February 2018, and which will qualify for the full tax relief. So let's assume he's got a capital gain. As I said, he sold a collective investment scheme, and he has the following income and expenditure. Now these are just random figures to illustrate the principle, to make it simple. Let's assume his salary is 1.4 million. Let's assume there's passive income of interest, 100,000, and he receives dividends of 20,000, and he has a trade income. That could be letting a business or a business on the sideline, whatever the case may be, usually something that is not subject to pay as you earn, where an employer withholds the tax. And let's assume that's 500,000, and he incurs expenditure which is fully deductible. Let us assume 100,000. So there are the facts. He made a capital gain. He receives a salary. He receives passive income of interest and dividends. He receives active business income, which is trade income, not subject to pay as you earn, and he has certain expenditure for that. Now, before we can do the tax calculation, we need to understand three very important concepts. Because based on these concepts, you will calculate the retirement annuity deduction. Number one is what is meant by remuneration. What is remuneration? To make it simple, usually that would be a salary, and most of those instances where an employer would withhold pay as you earn from your salary. So that is usually for the fixed salaried person, be it bonus, holiday leave, etc., etc. All of those are included. It would exclude trade income. Then we need to understand what is taxable income. Now, taxable income is a very important word in the Income Tax Act. So when you read the word taxable income, it means something very specific. So they say we must understand what is taxable income before we include a capital gains tax. And guess the third one is then, what is total taxable income after you've included the capital gains tax? So there's taxable income before you include capital gains tax and after you include it. You need to know both concepts because the calculation chooses, depending on circumstances, one or the other. Okay, so let's apply that very quickly. And let's do a tax calculation based on that case study. So there we go. You will recall I start off with gross income, and this format is going to stay the same right through. Start with your salary is 1.4 million. Interest is part of gross income. Dividends are included, and you include your trade income. And that makes up just more than 2 million. But in terms of the Income Tax Act, you are allowed exemptions. The interest exemption, which they wanted to do away with when they started with their tax-free investments, it's still on the books. So therefore, you get the interest exemption of 23,800. Dividends are fully exempt. It is true that you pay a dividends tax, but that is accounted for somewhere else where it's taxed at source. So it doesn't figure here at all, and it actually doesn't play any role in helping you to claim more towards a retirement annuity contribution. Then we have income. Now we're entitled to deductions. Your deductions is trade expenditure of 100,000. And a retirement annuity would also qualify as a deduction. So somewhere there, just after trade expenditure, we possibly will see the retirement annuity deduction. But first we have to do the tax calculation. And then we get to the concept that I've told you that we must remember. Taxable income, and there's the amount, 1.8 million, 1.876200, referred to as approximately 1.8 million. Now I add the capital gain because I sold my unit trust, and I get total taxable income. So there you have taxable income before you included the capital gain, and you have taxable income after you included the capital gain. And guess what? The retirement annuity calculation is going to harp on three things. It's going to be remuneration, which is your salary, or it's going to be taxable income, the figure you see there, or it's going to be total taxable income. And those three figures are important. And that's why we must do a tax calculation first. So let's just go over that. First of all, interest 100,000, there is exemption of 23,800. If you're over 65, it could be a bit more, and it's unlikely that figure will ever increase in future. It's just going to dwindle away. Then there are dividends. As I said, they are exempt, and it's a withholding tax. It's not reflected in the calculation, so we ignore that. And then we calculate the taxable capital gain, and that is calculated as follows: 540 minus the base cost, which I said the tax practitioner must be able to calculate. And then we take off the 40,000, that is a yearly amount that is excluded. You multiply by 40% inclusion rate, and that is 160,000 rand. That 40% is one that we must watch in the budget speech. If they increase that inclusion rate, it's going to have an impact on the calculation and actually assist us to claim more towards a retirement annuity. And then the tax tables, I'm not going to go into that, by merely stating that it's 45% and there's your tax due. So let's go back, and I've said it already, and make sure we understand what is remuneration. Now remuneration is defined, and you know now, subject to pay as you earn and salary. Remuneration is defined in the 4th schedule of the Act, and there it includes, there we go, salaries, leave pay, wages, overtime, bonus, gratuities, etc., etc., etc. Usually subject to pay as you earn. So that's a fixed amount. So in practice, when you want to calculate the retirement annuity and you earn a fixed salary, it's actually very simple. You don't have trade income. You simply take that figure. It's 27.5%. It is as simple as that. So let's do the tax calculation. And we've done this one already, and a tax due. And let's apply now these principles how to calculate the retirement annuity deduction. So first of all, it is now governed by section 11 capital F, used to be 11K and 11N, all is done away with. So that is the article, the section of the Act that you will possibly see a lot. The action words here is purpose, allowed, and contributed. So what they do here, say for the purpose of calculating a retirement annuity, you must do the full calculation. And then we will allow a certain deduction, but only on that what you actually contributed. You may qualify for a huge amount, but only what you contributed. And it could be to any fund, pension fund, provident fund, or retirement annuity fund. So where will it fit in? And there is the next slide. Do you see that in red? It's the same calculation after we've done the tax calculation, and we have to find the value, how big that retirement contribution is. Now, remember, the retirement contribution may be towards a pension fund, provident fund, and a retirement annuity. If you've been contributing to a pension fund, that adds up to the total amount. So we don't care if you contribute to a pension, provident, a retirement annuity, a combination of all three or two of them. It doesn't matter. It is towards these funds. That is totally different than the past. So it is immaterial from a tax perspective whether the employer made a contribution on behalf of the employer. So let's say a person who earns a fixed salary, his employer makes a contribution towards his pension fund, as they do. That is part of remuneration because it's a fringe benefit, and you will actually add it on to the salary. The same applies if the employer pays your medical aid. That is a fringe benefit, and that fringe benefit will be added on to your salary as remuneration. So the only question that remains now that we understand this is how much can we deduct in total? And here's the formula. The total deduction allowed in a year of assessment may not exceed the lesser of. So it's the lesser of A, 350,000, or B, 27.5% of the higher of a person's remuneration, and you know what that is now? Salary 1.4 million, or taxable income, and that is referring to the total taxable income, taking capital gains into account, which is the 2 million. So there we've got A and B, it must be the lesser of that. So it can never be higher than 350, we know that. And there's one more leg. The taxable income of that person before the inclusion of a taxable capital gain. And this is a new development. What they are trying to do is to say, we cannot allow you to take out a retirement annuity so that you run into assessed loss. So they want to ring fence it. And that's the purpose of that section, because you may have capital gains and you may have a huge retirement annuity. But if you have no taxable income, and taxable income referring to the 1.8 million, such instance, you do not qualify. All right? So let's just make sure we understand. Number one, the lesser of 350,000, or, and see the green now, I've pointed out, 27.5% of the higher of remuneration. Do you see the green salary? Or taxable income. Do you see the green total taxable income? It's the higher of the two, which is obviously total taxable income, whatever 27.5% is. And then the taxable income of that person before allowing CGT, and there it is in green. There are those figures. And this is how difficult it gets. It doesn't get more difficult. This is the way it is. So, what's the answer? It is the lesser of 350,000, the result of 27.5 times 1.4 remuneration, or total taxable income, which is 2 million something. C, 1.8 million, the lesser of that. So therefore the answer is 27.5 of 2 million. This person qualifies for 101,837, and that accounts for his pension, provident, as well as retirement annuity fund. And it is as simple as that. Now, just to make sure we understand, what if a person only has a capital gain and no income? Well, let's apply the formula. We know it by now. So there I've done the tax calculation where there's no income. It's a lesser of A, B, or C. So we apply the lesser of 350 or the result of 27.5 times naught, which is remuneration, salary is naught, or taxable income, that is total taxable income, it's 160,000. Or taxable income before capital gains tax is naught. So what do you think is the answer there? How much will that person be able to claim? And the answer is naught, because we do not allow a person to enter into a tax loss. And that's the purpose of the third leg. So let's take another example then. Let's say a person's gross income is 160,000 because his salary, now he's got taxable income. But he also made a capital gain of 160,000. So we apply the formula again. The lesser of A, B, or C. A, 350,000, that's a fixed amount. B, the result of 27.5 times 160,000, which is the remuneration, or taxable income, which is 320,000, that's a total taxable income after the inclusion of capital gains. And the third leg, the lesser of, is 160,000 because that is taxable income before capital gains tax. So how much do you think this person would be able to claim? And the answer is 27.5% times 320,000 equals 88,000. And that amount, the lesser of, doesn't throw it out. So that is quite a substantial amount. Here it illustrates clearly that even though you have a small salary, but because you made a capital gain in that particular year, which is huge, you sold off an investment, you actually can claim more towards a retirement annuity, but always limited to what the taxable income is. And this is a massive, massive, massive benefit and a drastic change from years ago. Good. So let me just complete the calculation, and there, after I've done the tax calculation, I claim the retirement contribution of 88,000. The deduction is 27.5% of 210. This is now where capital gain exceeds his salary, and his salary is 50,000. The calculation is 27.5% of 210 because it's a total taxable income. I'm taking shortcut now. I'm not repeating all three, which is 57,750. But his taxable income was only 50,000. So guess what? It's limited to 50,000. What I've explained now is going to be the difficult part that people are going to battle to get their heads around, is how does capital gain impact that? If you were to receive a car allowance and other remuneration, it's very easy to incorporate in this example. These are the main issues. Good. So now the question is, what if I made a bigger contribution than what I was allowed to? Because you might do that. There's nothing wrong with that. You're just not going to get the full tax deduction. But the question is, do I lose that? Or what must I do that I don't lose that? Well, what if a taxpayer makes excess contributions and the Act allows us? And this is what the Act says, and I'll skip through it very quickly. It says any amount contributed to a retirement fund, all three, in any year of assessment has been disallowed solely by reason of the fact that it exceeded the amount of deduction. So it was disallowed because it exceeded the amount of the deduction. Then it can roll forward, unless you use it as a deduction in this year or the following year assessment, or it's accounted for the second schedule, which is the lump sums, or they refer to section 10C. What does it mean? Let's just simplify. It simply says, if you made an excess contribution, it's deemed to be a current contribution unless you've used it in that year, or at retirement you add it to a lump sum, or after retirement you've set it off against annuity income. This is a perfect illustration where retirement planning involves pre-retirement planning at the date of retirement and post-retirement. There are certain choices to be made which has a tax consequence. And this is where a financial planner can advise and see the pitfalls. So let's do an example of each one and see how does it work. Now, my first example, let us assume on the same set of facts, this taxpayer didn't contribute now the 101,000, what's his narete, what he's entitled to. He says, I've got R1,000,000 and I'm going to throw it into a retirement annuity fund. In that particular year, he will get his 101,837 as a deduction. Let us assume the following year that everything stays the same. No salary increases just for the purpose of the calculation. And he made no additional contribution. He can claim exactly the same amount. And the following year, and the following year, until it's exhausted. You have the benefit that those funds are invested in a tax-free environment. No dividends, capital gains tax. Although you did not make a contribution. So those funds are working for you. So what does it mean? Are you worse off because you contributed more? Not at all. As a matter of fact, you're very similar to doing a tax-free investment. It's a very similar situation. Just that you've got to wait until 55. So the balance, as I said, of 898 is available every year until it can be deducted. And stated before, the growth in the retirement fund will be tax-free, same as a tax-free account. Okay, now, let's assume this person doesn't have 10 years and he's going to retire in 2 years' time. Now we at the retirement. Because I can't keep on claiming. Is there other options I have? Well, you do. You can still keep on claiming. Or when you take a lump sum from a retirement fund, you can actually claim it there. So here's the example. So let's say Mr. X retires from his retirement fund with a benefit of 6 million. And his lump sum is 2 million. Remember, you can only commute up to 1/3. And the idea is usually to pay off your last debt, etc. You don't have to take the full third. You can commute up to 1/3. Now, in my previous example, amount of 898,000 was not deductible. What happens with that? Do I have choices? Yes, you do. You take your lump sum. On the right-hand side, you'll see the retirement tax table. You take your lump sum that you received, 2 million. But before you go to the tables, you claim your credit of your disallowed contributions, which leaves you a balance of 1.1 million something. You take that to the tables and you pay the tax on that. So effectively, you saved on 36% tax. Well, that's wonderful. So we could claim it as a current contribution every year, or at retirement we have an option. But what now if the client says, but why must I take the full 1/3? Maybe there could be other options available. Maybe I only have debt of 500,000 and 500,000 is tax-free. I only want to take up to 500,000 and the balance in the annuity. Am I going to lose out? Nope. This is where the post-retirement tax comes in. So, assume the taxpayer took a lump sum of 500,000. Now, according to the tables, 500,000 is tax-free, assuming that it's the only retirement fund. And he chooses for that year annuity income of 200,000, be a living annuity or a life annuity, whatever the case may be. On the left-hand side, this is how you'll do the calculation. His gross income would be 200,000, and that's section 10 cap C that I spoke about. That is an exemption, not a deduction. It's an exemption. It's totally exempt. No tax on it. No questions asked. Therefore, that person will receive an exemption of 200,000 until the 800,000 is exhausted. So you can never lose out on these benefits. So depending on the risk profile of the client, he may have options available and there are tax consequences to them. And that's what I said. The yearly annuities will exempt from taxation until the full amount is exhausted. Now we can get into some fascinating stuff. We can actually contribute more to the retirement annuity, and we build up that credit of $898, even after retirement, which is not a bad idea. Okay, that takes care of all the income tax before retirement, at retirement, and after retirement. But surely there are other taxes. So let's have a quick look at estate duty. Now, let us assume Mr. X has assets worth of 10 million, liabilities of 2 million, and a retirement fund of 6 million. First of all, retirement fund proceeds since a couple of years are totally exempt from estate duty. There is no estate duty payable. So people use this opportunity. They took 10 million, and it could be a week before the person's death, and you throw it into a retirement fund and you escape estate duty. So that was an obvious loophole. So they changed and said, all those disallowed contributions that I spoke about earlier, that you will not be exempt. And there is my calculation. So let's assume the 898, that you've done it the first year, you've done $1 million, and you didn't have the opportunity at the date to retirement or at retirement or after retirement to use the tax break. That particular amount that was disallowed, that will be added on. So you're not going to escape estate duty on that. And that closes that loophole, which is very fair. But the tax-free growth in the fund, it's not being taxed. And there is a tax calculation to show you what the impact would be. So you're no worse off. But do you note that the 6 million retirement annuity escapes estate duty totally? It's only the disallowed portion. And that was because of aggressive taxing. So let's talk about some other strategies very quickly. First of all, we can compare retirement annuity versus a trust. A trust has been hammered the last 2-3 years, and we're going to have a look at the retirement annuity very quickly, and I'll show you that a retirement annuity is nothing else than a trust fund that gives you all the benefits, especially from a tax point of view, as compared to a trust. Professor Matthew Lester often refers to it as the poor man's trust, a very good description. Also, other strategies to counter ongoing tax increases, as I've pointed out earlier. So if the budget speeds, if they're going to increase the taxes, you increase your retirement annuity, and you still stay on track. A very important one is to supplement post-retirement medical expenditure, because there's been a lot of talk, been hearing, and people saying that they should do away with the medical credit. Now that is going to be a blow to taxpayers. So it becomes crucially important to make sure that the retirement annuity, as I said, it's a vehicle for many purposes, not only for retirement, but for post-retirement to fund that medical expenditure. And if they do not take away those tax breaks, it means when you do the tax calculations, it's easier to qualify for medical credits if you take out the retirement annuity. I leave that one there, and you can consult with your financial planner to find out more about that. So let's compare it quickly to a trust and a retirement annuity. On the left-hand side is a trust, a popular one. Why do I use a trust? Because everyone says you want to do estate planning, you need a trust. Now I say, you want to do some estate planning, start looking at the retirement annuity because it does a very similar thing. As a matter of fact, it is a trust. So here we go. I compare it from a tax point of view and what it does. So when we look at the trust taxable, the funding of a trust, fully taxable donations tax, and the new 7-cap C requirements deems it a donation if you don't charge interest. Very negative. The investment build-up in a trust is hammered. Capital gains tax, the inclusion rate 80%, and if that increases, which is not unlikely, you're really going to be penalized for any capital gains in a trust. On death, there are anti-avoidance provisions, although not very effective yet, and then income tax, there are also anti-avoidance provisions. So from a tax perspective, a trust is becoming very negative. Compared to retirement annuity, the funding is tax deductible. The investment build-up, tax-free. On death, no estate duty. So when you make that comparison from a tax perspective, it's a no-brainer. But you may say, but for the trust, I use it because the purpose of the trust is to protect the beneficiaries. Guess what? That's exactly what the retirement annuity does. And that is stipulated. in Section 37C of the Pension Funds Act. It is there for beneficiaries. You may say a trust is protection against creditors. Well, guess what? By statute, retirement funds are protected, all the approved funds. And management of funds is done professionally, where we need a third independent trustee. And so we can carry on. The point is, one will have to start looking differently at the retirement annuity comparing to a trust from a estate planning perspective, and what is it that you want. Tax benefits of using a retirement fund. Many taxpayers, as I've said before, we have very limited tax breaks. We used to have company cars and car allowance, and those things are becoming more and more difficult. There was an era with the 7th schedule where we claimed fringe benefits and we could lower the value than the cash value. Those were the good days. They're gone. But what came about is a retirement annuity where the deduction, in some instances, was limited in 2015 to 15%. It's actually now 27.5%, up to 350,000. And by the way, the Davis Tax Committee did recommend that 350,000 should be increased. That is not bad news. So let's quickly run through it. Tax benefits, contributions to retirement fund tax deductible. Capital gains may be used to increase the tax deduction. The build-up in the fund is tax-free. Tax break when you retire because you have tax-free lump sums. Excessive contributions qualify for tax-exempt income after retirement. Tax is deferred until 65 because you don't pay tax in the fund in the build-up. It is deferred at the later stage when you choose to retire and to pay the tax. The accrual of income after retirement can be adjusted. For instance, a living annuity, I can choose. Do I want 2.5%? Do I want to use of my discretionary money? Or must I use 4%? I have options, I have choices. I can actually determine the accrual from a tax perspective. If I have medical expenditure, maybe I will increase my living annuity because there's a good chance after 65 that you can offset that against the greater income. So let us then end off. What is the financial planner's role? Well, number one, don't expect him to be a tax expert and to go and do the tax calculations. As you have seen, often it's a tax practitioner who has knowledge about the share options and the car allowance, the valuation of assets, and it cannot be expected. But to guide us as how to calculate that, the deduction, that is the role of the financial planner. Foremost, the role is, what is it that you want? I want to achieve a goal of retirement. Are there tax implications? Yes, depending on the choices. Let me help you with the choices and give you factual information at the tax implications. And then a client can make an informed decision. So it is all about goals. Thank you very much for attending. Yeah, and if there are any questions, we've got some time available. Feel free to fire away and ask those questions. We'll pick them up here. Yes. Here's a good question. You can acquire assets in the name of a trust, but not a retirement annuity, which is a key benefit. Key benefit depends on the risk profile. You are quite correct. Obviously, a trust, you can choose many assets. You can have property in there, and you can have investments. Where a retirement annuity, you are limited to other investments. That is absolutely correct, but it depends on the purpose of the trust that you will take into consideration. See, can you help me just here with the other questions? There's some more questions. I'll go up there. I don't want to miss them. Oh, you must help me. Hi, I think I missed the first part, so I'm not sure if you have gone through the, that's a government pension fund contributing to that 27.5%. All I'm going to say here, one must bear in mind that government pension funds are often treated differently. And there are tax-free portions, and I think, I speak under correction, as 1998, where it's not taken into a calculation, and that's a calculation in own right. Also, maybe, word of caution, if you deal with a government pension fund, make sure that perhaps contact the Human Resources Department, that you have a full understanding of the rules, because they may differ. I mean, I can remember that years ago with the municipality. Even though they contributed to a provident fund, the employee, where no one is allowed a deduction, they were allowed a full deduction on a provident fund. But that was years ago. The next one, let's see if there's another one. On page 18, if the person has been contributing to the pension fund, where is that taken into account? I haven't illustrated because I did not want to complicate it. If you contributed to a pension fund, and look at my examples, then what you would do, the employer's contribution would be added on to remuneration. And then obviously, if you contribute a portion plus that of the employer, that is deemed to be a contribution by you. And that must be offset against any other further contribution. So it means that in totality, you will qualify for 27.5%. And it seems there are many other questions. Go that one. There are many other questions that is based on the same thing. Yeah. There is usually an employee and employer contribution. I have dealt with that. Tick that one. If the tax is 45% upfront, you pay full tax on more contributions than the 350,000 and only later receive lower tax rates on a rollover. I'm not quite sure what the question is, but it is true that there is a deferral of tax, but the growth in the fund, it is tax-free. And one can say, you know what, the fact that you're on a margin rate of 45% doesn't mean that you actually claim 45%. You've got to look at the effective rate as what it has shown. So when you're looking at tax arbitrage between what is it that I get as a deduction and what do I pay at a later stage, it's a very difficult exercise, and it will never match exactly the same. Yeah, that's one. Can you increase a current retirement annuity to increase your funds? Yeah, depending on that particular product, I suggest you speak to a financial planner, but surely it is possible. When it comes to other products and investment products, there often could be limitations as to additional contributions, but when it comes to retirement annuity, it makes sense to be flexible because your income may vary from year to year, so that would accommodate. Who has the obligation to keep record of the excess RA contributions not previously claimed? Now that is an excellent question. Number one, guess who's responsible? The taxpayer. Because in terms of the Tax Administration Act now, that the onus is on the taxpayer to prove it. But I can say this. If SARS disallows a contribution, it's going to show when you do your tax returns. So having a record of that will assist you because they have those records. So I think, unlike the past, it is a lot easier. This question, if I only receive a taxable income via pay-as-you-earn, I would say if you only receive remuneration via pay-as-you-earn is a withholding tax by the employer, and say I'm in a 41% bracket, do I simply calculate my tax refund by working out 41% of 27.5% of my income? No. No, it's not that simplistic. You unfortunately will have to go through the whole calculation that I have done. But let's see if I can make it simpler for you. If you receive an income, let's say of $1 million, that's all you receive. You don't contribute to a pension fund or nothing. It is very safe to say that 27.5% of $1 million would be your retirement annuity deduction. That's how I will go about. Let's take one more question. If you have never had a retirement annuity and are close to retirement, is it worthwhile to start an annuity, or should you rather considering share investments? How do you protect capital? Though, well, that is a mouthful. That depends on the personal risk profile. It is not about this product or that one. It could be a combination. But what I can say is this. A retirement annuity is not only for retirement. You heard my views on the retirement. The retirement is a word. Retirement has been removed out of the dictionary. So first of all, the date of retirement is just a day in your life. It doesn't mean you cannot contribute to a retirement annuity. you can continue contributing forever and ever and ever and receive the tax deduction, and you get to choose when you want to retire from that fund. So I think what you should do is definitely not put all your funds in a retirement annuity, because there's a quid pro quo that only a certain amount is liquid. You may want liquid funds available. But this is where a financial planner can assist and say, how much do I need as an emergency fund? How much should be discretionary investments, even though I pay tax? And what percentage should be a retirement annuity? Perhaps a good point of departure and say, how much do I qualify for a retirement annuity? I have surplus left. Well, let me balance it out. But definitely make use of your retirement tax benefits. And I see there could be a whole lot of questions, because there are many people. You are feel free to actually send us your questions, and we will be able to respond to you. So thank you very much for attending, and I hope you found it worthwhile.
Thank you very much, ladies and gentlemen, for joining us today. Hope you enjoyed the session. Should you want to take this further and meet a financial planner, you may walk into a Standard Bank branch close to you and ask to speak to a financial planner. Or you can check out the thank you note, which will be sent out tomorrow. It will have contact details where you can SMS the word goal to 31791, or you can call us on 0860-034-778, or you can email us at sbfccallcenter@standardbank.co.za, and a financial planner will call you to make an appointment. The webinar is recorded, and on the same thank you note which you will receive, there will be a YouTube link where you can go and watch the recording. If you are staff, you can also get the recording on the SBFC portal. Until next time, thank you and goodbye.
Yes.